everyone, and welcome to the next session in the Nordic Congress. It is my pleasure to welcome you to the next panel, Success in Investment in the Nordics and Europe. Just as a reminder, this is a live panel, so I very much encourage everyone to ask questions in the chat function, which is on the bottom right. And I'm going to hand you over to the moderator, Tony. Tony, over to you. Welcome you to.
Great, thanks, Becky. Good morning, everybody. My name's Tony Proctor. I'm the moderator for today's session. My background is as a lawyer. I'm a patent attorney for working with Potter Clarkson. We're a full-service IP law firm with offices in Stockholm, Copenhagen, and the UK. We have a very interesting discussion today. We're lucky to have a topic that has a question in the title because it gives us the challenge of trying to answer that question during the course of discussion. Unfortunately, Anne Tove is not able to join us on the panel today, but we're well looked after with our panel members. And so without further ado, I'll briefly ask them to introduce themselves, starting with you, Ingrid.
Yeah, thank you, Tony. It's great to be here. We'll do our best. My name is Inga Nakai. I'm a founder and managing partner of Hadean Ventures, which is a European life science VC firm with offices in Oslo and Stockholm. We invest across Europe, a little bit outside of Europe as well, and we have a particular attention to the Nordic region. We're quite broad in the life science space. We invest both in pharma, biotech, and medtech. And we're about to launch our second fund these days. And with that, we have over $200 million under management. My background is from clinical medicine. Worked in internal medicine and surgery back in the days, and I've spent the last 10-15 years on the investment side.
Thanks, Ingrid. Soren Moller.
Yes, hello. Thank you, Tony. Hello, everybody. My name is Soren Moller, and I am the managing partner of Novo Seeds. We are the early stage investment team in Novo Holdings, one of the world's largest life science investors. Our strategy or main focus is to build and invest in new Nordic biotech companies. And we have been at this for more than 10 years. We have 25 plus portfolio companies, and we have been involved in some of the large financing rounds that took place in the first half of this year. At Sendo, Muna, and Hemab are companies that we built from the get-go, and were able to secure significant Series A financing. So we can go into some of those learnings later in the panel. My own background is basically science, and I was operational in biotech companies before joining Novo Holdings about 10 years ago. Thank you.
Thanks, Soren. And Soren Lemonius.
Yes, thank you, Tony, and hello to everybody from me as well. My name is Soren Lemonius. I'm managing partner at Sunstone Life Science Ventures. So we are a Nordic-based life science venture funds, although focused entirely on early stage investments in drug development. We've been active since 2007. I think we've been involved in 50, 60 companies by now. We are on our fourth fund, which we're investing from now. Myself, I'm a cell biologist by training. Spent most of my industrial career in analytical instruments, also being an entrepreneur before I started doing investments, quite a few years ago by now.
Brilliant, thanks, Soren. Perfect. So to get the discussion started today, Soren Lemonius, I believe you have a quick presentation for us. And so while you're loading that up, I'll just remind everybody that we have a facility for you to ask questions. Please feel free to drop those questions into the discussion box as we progress, and we'll certainly do our best to get to as many of those as we can. So great, over to you, Soren.
Thank you, Tony. So maybe just providing the audience a bit of background for a couple of slides I'm going to be sharing with you. So at Sunstone, as a venture capitalist, you sort of very rapidly develop, let's just say, a strong opinions about how our industry is structured, what you can do and what you cannot do, and what works and what don't. And we try once in a while to challenge our own perceptions of how we tend to see the industry. As you may know, IPOs have really surged over the past 2-3 years. We've seen a lot of listings, and Sunstone has been involved in quite a few. And in many of these listings, and we've been listing companies both in the US or been part of listing both in the US and in Europe. And it's a returning discussion in some of those companies are the pros and cons of doing listings in Europe relative to listings in the US with European companies. And admittedly, I don't tell anybody, I have to say we've not been too fortunate, if you like, or lucky with the US listings. And we were beginning to think, are we overemphasizing the positive aspects of US listings? Are there some points we are missing when we sometimes think that doing things in the US is better than doing things in Europe? And on that background, we decided to take a closer look at actual numbers to get a sense of what is actually the value creation when you list a company in Europe versus US, or versus doing a US listing in the US. What is the liquidity you see, and how much money have gone in? And it's some of those slides or those observations we'll share with you, some of the conclusions. And as is frequently the case, then when we do these types of analysis, they also give us cause for additional questions, which you will see as well. But so basically, and now I just need to see how I can move the faces of my nice colleagues here. Yeah. So here we're looking, the way we looked at the value creation post IPO was to look at the peak value that the company achieves within the first year post IPO. So we went in and looked at the share price. How did the share price develop? And then we identified the period with the highest share price. And we used that as an indicator of value. Of course, this is you could to say, to some extent, say it's a surrogate measure of value, because of course, how long it was at a given value has an importance as well. But still, we think it's a relevant way to try and benchmark value creation post-IPO. And the first observation we made that you see here, so here you see in the table, European companies listed in Europe, European companies listed in the US, and US companies listed in the US. And the first observation we made, and which was a bit surprising, admittedly, to us, was that you don't see that much of a difference in value creation post IPO in Europe and in US. I think we had expected that there was a higher recognition of value in the US relative to Europe. There's a difference, yes, but it's not very big. And considering the data that went into it, we don't really think it is significant. So you can't really argue from a value creation point that you should be going to the US. Another interesting observation that surprised us a little is when you look at the race to date numbers, right? The amount of money that VCs and crossover investors have put in before you can do the listing. Here, it might be just worthwhile mentioning that we took all small listings out of this. So any listing that was below 25 million euro in terms of money raised, we took out to sort of get all the European very small listings out of the picture. So you could say the EU to EU listings here are actually quite substantial listings in EU. And it's quite interesting. We think that in Europe, it takes you these about 40 million euros to get you ready for a listing. Whereas if you want to go to the US or you want to list in the US, on average, it takes you more than 100 million euros to get ready to that. An obvious question is, of course, does the stage play into this? And I don't have the figures here, but when we've looked into it, we can't really see that is the case. That you could argue that, well, Europe, they're just listing things much earlier. It takes more maturity in the US. Our initial impression is that's actually not, well, definitely not the full explanation. It is just more expensive, if you like, to be ready for listing in the US. Here. So here we then took this peak multiple. So you're looking at the peak multiple. So this is the highest multiple that the company achieved post-listing on the y-axis. And then you're looking at the time to that peak on the x-axis. As you can see, you have these 60 months representing the 5 years period that we looked at. And then you also have we basically took out 6 months because as some of you will know, we always end up in a lockup agreement with the banks that do the listing, that we won't be selling shares immediately post the IPO. So we don't really look at that. That's why that is blank. So although, as I said, the averages of, and here, of course, you see the US to US in black, the EU to EU in red, and the EU to US in green. And although you can see, as I told you, the averages are not too different, you do see one quite significant difference between the US companies listing in the US, which is that they potentially develop the value faster. So on average, they're close to the same, but it could look like that you pick up value faster when you're taking a US company and listing it in the US. This could be because in the US, with a US company, you can also do a listing earlier and get a higher multiple faster. We don't know. It's one of the things we would like to look at and understand. How come you have this population of US to US companies that gets this value faster? Then you do also see here some of you will have noticed a European to US outlier here, which I think is that comes up with a very high multiple, which I think is BioNTech. Another surprising observation to us here across the board was that about 20% of the companies lose value post-listing. We think that is a surprisingly high attrition. I mean, these are companies that are vetted out by the best banks and have several potentially value-creating milestones, and then that many companies basically fall below the IPO price and never recover from it over 5 years. That is to us also a bit of a surprise. So we don't think you can justify going to the US with an IPO based on our numbers and what we've looked at based on value creation. It's not like the investors there will recognize value better than in Europe. But we did find one thing, as you can see from this little table, that is very, very different from Europe to US, and which you could probably argue is one of the fundamental challenges we then face with our stock exchanges in Europe, and that's the liquidity. Basically, how much does these companies get traded post-IPO? And as we as investors obviously need to eventually get out of these investments, this is a very important parameter. I mean, you can't really use value recognition for anything if you can't sell your shares. That's pretty obvious. And you could say this is quite an interesting, important observation and an important argument. While if you're able to invest enough to get ready for a US investment, why you could consider doing a US investment even with a European company, because the liquidity, the interest to trade shares is just so much better in the US. So those are some top line conclusions from the presentation or from our small investigation of listing companies in the US versus doing it in Europe. And I'll hand it back to you, Tony.
Brilliant. Thank you, Søren. Certainly some very interesting findings there, and I'm sure our panel will be eager to jump in. I noticed you were taking quite a few notes there, Ingrid. Did you have any initial observations?
Yeah. First of all, thanks, Søren. It's a very interesting analysis, and I think exactly as you pointed out, right? Sometimes in the venture capital industry, we have sort of certain gut feeling and sort of given ways of doing things and assume facts of how things are. So it's very good to sort of take a step back and do the analysis now and then. And we've also looked at this from our angle with certain similar results. I think that, looking at your results, in some ways, I was sort of surprised that the difference on the multiples weren't higher. But obviously, I mean, the companies, as we saw, they have higher investments before they go public. So obviously, sort of, they need that higher valuation in the US public markets to get the same multiple as here in Europe. And obviously, it sort of gives a selection bias, right? Because there are high hurdles to list in the US. So these are sort of probably some of the most successful European companies that go that. I think that it still sort of validates the fact that we have this valuation arbitrage between US and Europe. But maybe what it shows is that to leverage this valuation arbitrage, make use of it, we still need to keep the elements of sort of the European ways of doing things with sort of capital efficiency. It's only in that way we're really able to if we're able to extract that value, right? To have develop our companies with capital efficiency in Europe and list at higher valuations in US. Maybe in that way it's more potential to extract value here. But I mean there are many open questions here, and I think this is sort of an experience as well of many in the sector, and probably will make more of us look at European listings as sort of good alternatives as well. But of course, I mean, one thing, and you pointed this out already, is sort of the liquidity, right, which is obviously a huge advantage in the US. Obviously, for us, for the same multiples, if you get that same multiple with higher liquidity, that's definitely a huge advantage. So.
Thanks, Ingrid. Søren M., did you want to jump in?
Yeah, thanks. I think my reflections is that it's a great analysis, Søren. Thanks for that. And I think it does confirm some of the thinking or our gut feeling that it is more attractive in some aspects to list companies in the US, but they also have to be more mature and with a management team that is ready to spend time in the US and take all the calls with the analysts and banks and really invest in getting on the radar. So maybe the market is open these days. There's also a lot of competition for airtime between what are exciting companies. But in any event, I think at least bringing this this current IPO window back to how we act as investors today, we do think about, when we look at new companies and new opportunities to invest in, how to make sure that we have a journey or a route to a potential public listing, and not only focusing on the M&A route, because experience have taught us, and not only us but many investors, that optionality is good. So you may wait for that magic M&A decision to be taken, but it's not within your control. That your company fits with the buyer's strategy and timing and ability to engage. So having an alternative route for raising capital and potentially exiting your position is something we try to think think, into our investment thesis very early on. I think that is my reflection on this, and the fact that there is a US opportunity and a potential European market as well is good. I think the liquidity data from your side is really striking and illustrates a big difference. So that's good food for thought.
Thanks, Søren. Søren L, did you want to pick up on any of the points raised there?
Yes, I think as Søren pointed out, I think we think very much the same way in terms of so there's a IPO window now. And it has become more part of our thinking, how it's part of the evaluation criteria that goes into our assessment of opportunities. Could you IPO this? Because that's an interesting discussion, right? Are there companies that are more IPOable, if that term exists, than other companies? And if so, what is that ingredient? And how do you balance that off in the development, the portfolio development of the company? I think that's we look at that and we discuss that, and that's become part of our evaluation criteria. Maybe on the I think the cost of developing an European company to a US listing is an interesting observation, if you like, or conclusion. And we've been asking ourselves how much, because you can do European listings without necessarily having a big crossover investment that you typically see in US companies. And we have been asking ourselves how much room of that volume, I mean, these 130 on average raised, how much does the crossover take up? How frequently do you see that you need to have that crossover as you do the listing? How much of the step up from the 50 to 150, being a EU to EU, EU to US, is actually that crossover that goes into the IPO, which would make it, then it becomes a bit of an artificial cost of doing it, right? You still need to raise it, of course, but it doesn't really then reflect the cost of developing the company to a certain point.
Thanks, Søren. Just picking up on a point you made there, I think for thinking about the startups and SMEs that we work with at Potter Clarks, and particularly in the life science sector, I think one thing they'd be interested to know from the panel is at what point do they need to start thinking about their strategy in order to attract investment? And you talked about going down the license and acquisition route versus building the company to be IPOable. I think we've created a new term there today, so you can take credit for that, Søren. And also, is that shaped to any extent by whether or not the company is working with a platform technology versus a single asset, and how does that affect the approach? Maybe Ingrid, if you have any thoughts on that.
Yeah, no, I think I would second what both Søren said earlier here, that we're definitely, when we look at a portfolio companies, looking at sort of parallel tracks here. Opportunistically try to make the best choices, whether that is going through an M&A process or IPOing. That boils down to the specific situation. But obviously, as Søren M also pointed out, right, when you're in an M&A process, you can try to sell your company as much as you like, but the company is being bought, right? So this decision is somewhere else. Whereas when it comes to IPO process, you can much more proactively steer towards that. Obviously, in that situation, it's not entirely in your hands, because obviously you need the market conditions to be there and the IPO window to be open to be able to pull that off. But more than in an M&A situation, you can steer towards that. When it comes to sort of the specific investment opportunities, we're bottom up and we look at each investment case on its own merit, whether it's sort of a single asset or has a big pipeline or platform technology. So that is, we don't have any strict criteria as what we need to see yet or what we don't want. We do each single analysis and investment decision based on that. But obviously, if you want to go down the IPO route, then typically you do need more than a single asset. You need sort of a pipeline, and either you have that or you need to get that somehow before you do the IPO.
Thanks, Ingrid. Soren M., how would you view this at Nova Seeds?
Yeah, can I think I wanted to come with one comment to your analysis, Soren, and then I'll go back to the question. So the cost of developing a company to an IPO, I think maybe it has historically been cheaper in Europe, but I do think that the good news is that in somehow the sun is shining on biotech also in Europe, and also especially I guess here in our region in the Nordics. And what I was mentioning in my quick introduction is that it is possible, or we are seeing significant financing rounds getting done even at a Series A stage. 50, 60, 70 million dollars being put into very early stage companies from good syndicates, international participation, very broad, both European, Nordic, and US investors stepping into these early stage companies. And I think that enables them to do the right thing, hire the right talent, have enough time to go through the ups and downs in any business plan that you experience in an early stage company, and potentially not spend too much time waiting for the next money to come in, but being able to push ahead full speed and do the right thing. And I think that will affect the value creation from an early stage company to an IPO-able company. So I think that is an opportunity that is there as the market is today, and we should definitely do our best to take advantage of that, because I think it is a great way of delivering to the best possible extent on the scientific potential in a novel concept. And then, going a little bit back to your question on this is then how we try to address early stage investments, is that we would like to, or we engage heavily with the entrepreneurs and work with the teams to come up with a substantially ambitious plan that would allow you to bring in international investors at the early stage, and then be in a position to, if you're successful, use that network and leverage to then bring in the Series B and the crossover round. So you are ready for that journey that we, at least for now, see as a very successful route to value generation in the biotech industry. And we can, if this is important for the panel, we can discuss more detail how we've done this in a couple of cases, and we hope to be able to continue to do that.
Thanks, Soren. Yeah, I think it would be interesting to come back to that, but I wondered, Soren, Elle, whether you wanted to jump in with any perspectives.
Yeah, so I think I was thinking about while Soren and I think it was talking, where is it actually you see, where do we have the hard decisions to make that relates to whether you can IPO or M&A, or that balance sort of changes, right? And I would say maybe kick off with saying all the numbers we've looked at, we would any day as a VC, these Sunstone prefer to have an M&A. If you look at grand average multiples and go through it all, you compare things that was IPO'd or sold, or your opportunity to sell shares, we would at any day prefer an M&A from a Sunstone perspective, which also means if you walk into our office and says we are IPO only, we don't ever want to sell this company, we want to IPO it and grow something big. I think that's fine. I think that's great, but then it's probably not with Sunstone. On the other hand, I would say, in like Ingrid, we always see things in its own right and by itself right. So whether it's a single asset or platform, we will consider both. And both, I mean, we have excellent IPOs of both types, so both things can be done. I mean, we've done possibly the single assets are more smaller listings, but that can be very successful as well on smaller stock exchanges, right? So it's not an either or. Where you may see, and as Inga very important point out, I think Son as well, IPO, you can do that by yourself. M&A, you get acquired, you never know. You just need to keep your door open. So of course, having an IPO in your schedule is a very good thing to have. Then when do you start to sort of potentially make decisions that brings you closer or further away? And that's probably when we have discussed is when you're doing licensing deals that can be very supportive for an IPO, but you need to think very careful about if you want to keep an M&A opportunity alive for the company. I think, and it's hard to give any guide, that's just where I see we have this sort of tough discussions within the portfolio, how to balance things. This is where this discussion, M&A versus IPO, becomes very, let's say, vibrant, because you can do a license agreement that is supported for an IPO, but not very supported for an M&A. So I just wanted to put that in there.
I just want to follow up a little bit on Søren's comments on the capitalization, like funding on the company. What is sort of the ideal funding? And I think, you know, historically in Europe, we had a problem with underfunding, right? And specifically also in the Nordics, right? Yeah. And where we've had companies on a shoestring, they haven't been able to run sort of the right development plans, etc. And that is definitely improving. As Søren pointed out, we have bigger rounds. We're more able to hire the right people. We're able to run the right clinical trials. So that's great. And then sort of the funding rounds are growing. And at a certain point, it's too much, right? That additional capital is not able to create more value in the company. And sort of the multiples and returns are suffering for that. I think that right now in Europe, what we're seeing, we're not there yet. I think, especially in Nordics, I think the funding rounds we're at a good level with that. We're getting sort of the capital we need to the companies more easily without sort of overdoing it. I think in US, it's more of a problem. Obviously, I might be biased here, but I think like in Europe right now, we're sort of getting at a good level, better level.
Thanks, Ingrid. Just to pick up on another point that I think is interesting in terms of assessing investment potential, and you mentioned, Søren L, that from a Sunstone perspective, an M&A strategy is typically preferred. But what about the situation where a company's already public, and to what extent does the IPO strategy affect the decision to invest? And it'd be interesting to go to you first, Ingrid, because I know Hadian's had some recent experiences in this area.
Yeah, absolutely. And basically, historically, as just mentioned, right, funding has been a problem for many life science startup companies, and it's been very little venture capital around. However, public markets have been an option, so that many early stage life science companies have taken that opportunity to get funding and gone public very early, too early in many cases, and that has sort of severely punished them on markets when we look at the valuation and the share price. And we see potential there from the investment side. Abliva is one company we've invested in recently that is listed. We currently hold a significant stake in Abliva. And our thesis here is that we are in a position to help these companies better develop their potential that we can leverage. And if it's success, like Abliva was the first case we've done like this, and if it's success, we're likely to do more of these types of investment. So cases where we think that just public markets have a poor understanding of the companies and are not valuing them right, and that basically creates opportunities for investors like us.
Great. Thanks, Ingrid. I noted you mentioned that point about understanding how to work with companies and to help increase value in that sense. And Soren M, you mentioned some examples of how you would work with companies. Did you want to pick up on a few of those?
Yeah. I think generally, the way we have started some of the, or been first investor in some of these companies has been that we sort of we engage with the entrepreneurs. We have a team of entrepreneurs in residence that we engage with and work closely with to mature and develop early stage ideas. And what we've been successful with recently is to, with this team, put in some, I guess, substantial money of our own to get the team in place, do the first de-risking experiments, and be ready, have a story and a team and a data package that substantiate a substantial Series A investment. A good example is Muna Therapeutics, where we engage with Anders Hinsby and Rita Ballis-Gordon in a very early stage. They were helping us sift through various assets and opportunities that came across and fitted into a neurology company that we had the ambition of building. And fast forward, we put in some money, did some de-risking experiments, in-licensed assets both from academia, founding academia, and also from CROs, and we were able to raise $70+ million in a nice Series A round, which is, from our perspective, is by far orders of magnitude larger than what we would normally would be able to raise. Another good example is Adicendo, which is a spin out from the Bioinnovation Institute here in Copenhagen, where the maturation process that project came through in the Bioinnovation Institute put together a very nice story, data package, and a good founding team. And our contribution was to co-lead the investment, find the chairman, and in the context of the conversation here, that with the ambition, raising enough money with the ambition to build out a pipeline from the main asset that came out of the Bioinnovation Institute. So those are a couple of examples of how we've been successful recently in leveraging all the interest in Nordic biotech, in the recent years. So I think that's a good model, at least to think about.
Thanks, Soren. And maybe we could go to you, Soren L, and just thinking about what you said in terms of preferring an M&A strategy, but would Sunstone consider investing in a company post-IPO, or?
So currently we cannot, but I do think that at the end, Inga is onto something, to a very interesting and exciting opportunity. I think it's a real opportunity. I think it's very unfortunate if they're going to use n = 1 to determine whether to go on with that, because I think Inga is very correct. I mean, particularly here in the Nordics and in Sweden, we've seen a lot of too small listings of quite interesting companies that are now struggling to raise. I mean, we all know that our industry, I mean, they get delayed and things doesn't quite work out. And if you're on the stock market and you've sort of raised money on a single asset and an upcoming single milestone, the punishment is very hard. It's very difficult to raise the next round. So there is an opportunity there. I think that's very correct. But of course, it also comes with some challenges, right? Because already now we need to manage. You need to we get actively involved with our portfolio companies. We try to help out. We want to understand what's going on to a very detailed level. And at the same time, we are there to eventually sell our shares. And that creates specific challenges in listed companies, of course, that you want to get really close, you're going to get really involved. And at the same time, you want to get out. And And with our size and what we do, you need to walk that line very, very carefully, not to get conflicted with the public market on what you are doing. So, so I think it's very, we think there's an opportunity here. We think we still haven't worked out how you potentially could pursue it with the way we work and do things. But I think it's great. And I think what Hadian is doing is, I mean, it's new, it's not really been done in the Nordics before. And I think that's interesting. I think what Novoseed is doing, building companies, basically more or less greenfield, is also new. I mean, we would love to do something similar. It does take a bit of a financial muscle to do it and to stay in there and sort of put the many eggs into the baskets you need to do to also get the successes right. But I think it's great that it's ongoing, and I think it's great it's ongoing very, very next to where we are doing our business.
Thanks, Søren. We've had a question from the audience that I'd like to put to you. So in an earlier panel discussion, Adam from NASDAQ was talking about greater international investor interest in the NASDAQ Nordics and EU markets on the public side. Are you seeing the same on the private side, with more US investors looking at European companies and syndication opportunities? And do you see this continuing? Maybe if we stick with our pattern, and I'll go to you first, Ingrid, if that's okay.
Yes, we definitely see more interest from US investors in European and also Nordic companies, and that's probably a trend that's going to continue and become stronger. As we talked about earlier, it's a lot of capital in the US, and obviously capital looking for returns. And I think we all here think that Europe's a good place to look for it. That said, the European ecosystem is still driven by the European players. So the dynamics we see right now with bigger funding rounds, better funding, etc., that is primarily driven by the European players becoming more and stronger. So yes, we see elements of US investors, but again, this is Europe, and it's primarily driven by the European investors.
Thanks, Ingrid. Søren, do you have a perspective on that?
Yeah, I have less visibility, I would say, into sort of how much interest there is from European or US investors on the public side, but at least on the private side, there's definitely a lot of interest. And I think it is a testament to the professionalism and the quality of the companies that are here in the Nordics and in Europe, and that US investors have recognized that because of many reasons. One new reason is probably COVID, that it's easier to do a virtual meeting and a virtual panel than having to travel, and therefore to some degree, if you have existing relationships, it is easier to look at the actual asset in itself and get excited about that. At least we have seen that there's increased interest in our portfolio companies from US private investors. But I do see, at least from the public side, I think there is an interest potentially from US investors, but they would probably have an eye to a cross-listing in the US, so looking for opportunities that have that ambition. That's just a gut feeling. I don't have any data to support it, but maybe Søren can tease it out of his big database.
That's a perfect question to put to you, Søren. Hel, did you get any information that would assist in that from your analysis?
No, we did not, but we know so we've had 2 cross listings in portfolio companies that they're not there, but as you may know, Sealand cross listed and Orphazyme cross listed, and I wouldn't say it was very successful. I think, of course, that's a little time ago, but still, I don't know how, for these early stages, I probably believe that the US investors on the public side are still US focused, but looking for the crossovers like Søren pointed out. On the private side, I think it's unquestionable that the US investors are having a much bigger footprint, much more interest. Going back to a question of or the question whether it will last. I think not. No, I don't think so. I have to say, I think it is a reflection of course, the quality needs to be there, but it is also highly, I think, very much a reflection of a surplus of cash in the financial markets that we're seeing right now. I don't think it's going to continue. I think there's a huge overlap with what we saw back in the turn of the century. We also had US investors visiting in the portfolio companies we had back then. We had US investors coming in, and as everything started drying up, it all went away. And for years, we didn't see US investors, and now they're back. I think it will change again. I also think, but I think, and that's quite interesting about venture capital, right? We raise funds for quite a period, right? So we raise funds, and typically we have investments periods ranging from 3 to 5 years. So there's a carryover of the situation right now, if you like, that there's a lot of cash in the market right now, and because it's impacting fund sizes, new funds, there's going to be a tail of this that extends into the future. Even if fundamental financials change, we still have quite a bit of cash that we need to get deployed into portfolio companies. So it's not going to be just around the corner, but I think it'll happen 3, 4, 5 years down the road.
Thanks, Søren. So we're coming to the end of our allotted time, but if anybody has any more questions, please feel free to drop those into the comments box now. But as we wrap up this discussion, I think it's probably interesting to come back to the question that's posed in the title of the panel, which is success in investment in the Nordics and Europe. Is it time to recalibrate? And I guess an element of that is thinking about the post-COVID watershed that we're going through now. And maybe if I could go around you all again, just to get your thoughts on that. Ingrid, did you want to add anything on that topic?
Yeah, it was good to say post-COVID. Yeah, hopefully we are there. Let's see. It's a very unpredictable pandemic. But no, I think we're in a good place. As mentioned earlier, I think the financing of our European companies, Nordic companies, are getting more appropriate. And yeah, I think right now we're in a good spot where we're at sort of a good balance of less problem with sort of severe underfunding we've seen historically, and not yet a place where it's overflowing of capital. So I think we're in a good spot.
Thanks, Ingrid. Søren M.
Yeah, I would tend to agree that all businesses go in cycles. So we can't hope. We can hope, but can't promise that the current environment will continue. But at least I think we are in a good place in the biotech industry, because science is really picking up and solving some of the big problems. There is, COVID has really illustrated that life science can solve some of the world's big issues, and this has attracted money to the sector. I think, as I said, the sun is really shining on the Nordics at the moment, and we should do our utmost to take advantage of the moment and get good companies and ideas funded. And I'm sure that that's going to happen also the next few years.
Thanks, Søren. And then finally, as well as your final thoughts, Søren L., I think you're also very well placed to answer our final question, which has just been posed, and that is, being a Swedish NASDAQ listed company, would the panel see any advantages of a US listing to more easily access and attract US investors? I think your research makes you very well placed to answer that, Søren L.
It depends a lot on the size and nature of that Swedish listed companies. I think knowing the Swedish listed market quite well, I could point to companies that I'll say that could be worthwhile a thought. But if it's a small listed company, I don't think it would be worthwhile. I don't think it would be advisable. Then I think you should be building your equity story more in Europe than in the US.
Thanks, Søren. And did you want to add anything on the general recalibration topic?
I don't think there's a recalibration. I think you should be very aware of ever ongoing changes in our industry. Right now, as Søren points out, we have some very positive fundamentals and for getting additional funding. You can do bigger rounds. But that is just our industry. It's dynamic. It keeps on changing, and it's not a recalibration. It's being an entrepreneur. This is what they need to be really good at, adaptive and on their toes, and ready to respond to our ever-changing industry.
Thanks, Søren. Great way to finish. So thank you all for an excellent discussion today. I'm sure all of our panel members would welcome anybody who wants to reach out to them on LinkedIn or elsewhere if you have any remaining questions. And we're all very grateful for you joining us today. And I'll hand back to you, Becky.
Thanks so much, Tony. And yes, just to reiterate, obviously what was just said then, a huge thank you to all of the panelists. 45 minutes always goes so quickly, but do absolutely reach out via the platform, make those connections. That's what we're all about. And obviously, continue the conversations on the platform and off of it. So thank you once again. It's a pleasure to have sort of had this panel discussion, and I'll see you very soon for our next panel discussion. Many thanks.